One of the key questions we ask is what will drive performance in the property market? And there are four questions which we ask. It's about, is it the UK economy? Will it be interest rates, the global economy, or the weight of money? And in 2014, we got this shock result where 70% of the audience were saying that weight of money would drive the property market. What was interesting, again, was to look at their response in terms of how they thought that might translate into property performance during the year. And in fact, the average expectation was that it should be between 7 and 12%. Very few expecting greater than 12%, I think barely 1%. And some bears in the audience also expecting it to be less than 7%. What we found, of course, in the actual returns, and we've only got the monthlies out now, is that total returns were approaching 20%. So although the audience in 2014 thought, yes, there will be this huge weight of money that comes into the market, how will that translate in property terms? They underestimated really the strength of yield compression, which then drove the returns. Now we're seeing in 2015 quite a similar pattern. The 70% has become 65%, and we're seeing more people expecting performance in the UK economy to drive returns in terms of rental growth. Nevertheless, the crowd is still telling us that property performance will be very similar to their expectations, so lower than last year's actual outturn, again in the 7.5 to 12.5% range. So it'll be interesting to see whether the market can actually sustain further yield compression, in which case there's no doubt that property will perform better than the crowd is suggesting it will, or whether the crowd is spot on that yields will stabilise and those will be the actual returns.
Well, the UK economy is now delivering reasonable growth once again, but in terms of external problems, I mean, the obvious one is Europe, where, and particularly the Greek situation, where it seems reasonable to assume that a compromise will be reached, but if it's not, then things could unravel quite badly. There could be, quite serious chaos on the financial markets, perhaps precipitating a further recession in Europe. So obviously that's one to be closely watched. I think rather further afield as well, there are potential financial risks in possibly, Russia defaulting, triggering more defaults around the world. So there is a risk of, if you like, financial defaults undermining the progress of the world economy.
So 2014 was a record year for volumes in the UK, over 60 billion, eclipsing the previous record of 2006, but for very different reasons. People are looking at real estate now because it delivers income, and income is something which is important in everybody's minds. People don't want risk. They're not looking for big capital growth at the moment. They're looking at something that can provide dependable income, which is why real estate is attractive. UK real estate is very attractive, and overseas investors are still clambering for more. Today at Prospects for Property, we announced that we saw that Brookfield and Bogatari DR Investment Authority have bought Canary Wharf. That's just the start of other big transactions that we think we'll see in 2015. Dry powder money the private equity sector has raised for real estate is something like $250 billion available for worldwide investment. A lot of that will come to Europe, a lot of that will come to the UK. UK funds are growing their real estate teams, growing their real estate investment, and they're growing the sectors that we're investing in as well. So we expect to be very busy this year. Provided the stock's there, it could be another record year.
There's going to be some very broad occupational themes coming through the sectors in 2015. So for offices, we can expect it all to be about flexibility. So flexibility of location, flexibility of cost, and accessibility. If we look at the London example, we can see occupiers looking much further afield than our standard core markets than we've ever seen before. New geographies emerging, and those are becoming established, and they'll continue to be so. For retail, a sector that's had many challenges over the last decade, it's about building brand and loyalty. And one way of doing that is through technology. So retailers are using more and more technology to bring consumers through the door, whether that's allowing them to pay for hotel rooms with their mobiles or opening hotel doors with their mobiles and not having to queue, for example, or paying for their coffees using their mobiles. So Starbucks have 7 million payments per week on mobiles these days. This all builds brand and loyalty. For logistics, it is all about a changing urban logistics model. Those pressures that we see in retail are coming through to the logistics sector, and it's all about how we consumers expect our goods. We expect them the next day, we expect them the same day, we expect them to be at the train station, the tube station, at home or at our offices. It's not a sustainable model. Something's got to give. The two areas which will change: one is consumer expectation. Retailers will seek to find more efficient ways of getting our goods to us. Click and collect is an obvious one. And the second is the operational model. So more urban consolidation centres, which will allow a much more efficient use of logistics to get the goods to the consumer.
I think the high yielding is expected, especially in the so-called secondary locations, or B locations, as we say in continental Europe, which means in the outskirts of Paris or in the subsidiary of Frankfurt. This could be bring you 200 basis points higher than the so-called core trophies in the city centers mainly. And this is one opportunity. The other opportunity is you dig deeper and go directly to the development projects and development activities. This will bring you again 300 basis point difference to the core property in these days. And I think this is again a ride of the risk curve, which will cause us extremely positive sentiments for the next 2 years within Europe.